For years, the rental market felt brutally one-sided. Landlords dictated terms, rents exploded, and tenants were expected to accept whatever increase appeared in their inbox. Across the country, prices didn't just rise, they surged at a pace that erased savings, delayed families, and locked generations into survival mode. The message was simple: pay up or move out. And for a long time, there was nowhere else to go. Then something changed, quietly, unevenly, without a dramatic headline or crash moment. The leverage landlords held began to slip. New buildings came online, migration slowed, paychecks stopped keeping up, and renters, stretched thin, started saying no. By 2026, the shift is no longer theoretical. In several major cities, rent isn't just softening, it's collapsing. What makes this moment easy to miss is how it's unfolding. National averages still look stable. Official reports lag reality. But beneath the surface, specific cities are breaking first. Vacancies are climbing, incentives are back, free months, waived deposits, quiet discounts once unthinkable. Landlords who screened dozens of applicants are now chasing one. This isn't about a housing crash, it's about a power shift, a reversal of momentum that hits fast once it starts. Investors overbuilt, owners borrowed assuming endless demand. Markets priced people out and expected them to stay. That math no longer works. If you're renting, this is relief, options, leverage, breathing room. If you own property in the wrong city, it's anxiety, cash flow pressure, and here's the critical part. The damage isn't evenly distributed. The cities ranked 3, 2, and especially 1 are already showing panic behavior. Most won't notice until it's obvious. Stay with me. This isn't just a correction, it's a reset before the narrative changes. Subscribe and hit the bell. This channel tracks housing shifts before they become headlines. Rent doesn't drift downward the way home. Prices do, it snaps. And once you understand why, the recent chaos across rental markets stops feeling random and starts looking mechanical. Everything begins with overbuilding. During the boom, developers raced each other to pour concrete, assuming demand would rise forever. Projects approved in optimism finish years later in a very different reality, dumping thousands of new units onto markets that no longer need them. Then comes the affordability wall. Rents can only rise as long as paychecks stretch. Eventually they don't. Groceries, insurance, debt payments, and taxes eat away at flexibility, and renters hit exhaustion. They don't upgrade. They double up. They move home. They leave cities entirely. Demand doesn't vanish dramatically. It thins quietly, just enough to break the balance. That's when vacancies appear. Not all at once, but scattered. A few empty units here, a half floor there. At first, landlords ignore it, confident the market will absorb the slack. But rental, math is unforgiving. One empty unit erases profit from several occupied ones. Cash flow tightens fast, especially for owners carrying high-interest loans. Incentives follow almost immediately. Free months, waived fees, parking thrown in. These aren't acts of generosity, they're pressure valves. Signals that owners need bodies, not top dollar. And once one building caves, the entire neighborhood feels it. Renters compare listings, leverage shifts. This is where panic enters. Unlike homeowners, landlords can't wait years. Mortgages, taxes, insurance, and maintenance arrive every month, whether units are full or not. Oversupply turns confidence into urgency. Interest rates amplify the effect. Higher borrowing costs mean thinner margins and less patience. What felt sustainable at 95% occupancy collapses at 90%. That's why rent declines feel sudden. It's not a slow repricing. It's a snap triggered by leverage, debt, and too many keys chasing too few tenants. By the time headlines announce falling rents, deals are already happening quietly behind the scenes. If you're renting, understanding this changes everything. You stop chasing listings and start negotiating. You recognize incentives as weakness, not generosity. You move earlier, while fear is still subtle and options are plentiful. Knowing the timing lets you choose better neighborhoods, stronger concessions, and calmer decisions instead of reacting when inventory is gone and confidence returns to the market cycle. Subscribe and hit the bell. If you're renting in one of these cities, this is leverage most people miss. Number 10 is Austin, Texas, the city that became the symbol of modern opportunity almost overnight. For years, Austin was sold as the perfect blend of creativity, technology, and affordability. Remote workers flooded in, startups followed, and developers raced to reshape the skyline. Towers rose faster than the city could absorb them. Rooftop pools, co-working, lounges, and glass balconies promised endless demand, and for a while it worked. Rents surged, competition was ruthless, and landlords felt untouchable. Then the ground shifted. Tech hiring slowed. Layoffs rippled through companies that once anchored Austin's renter base. Thousands of high-income tenants quietly disappeared, and the supply they left behind didn't. New buildings opened into thinning demand. Units sat longer. Floors went dark. What looked like a temporary pause turned into a pattern. Landlords began offering concessions they swore they'd never need again. Free months returned. Fees vanished. Negotiation came back. Austin didn't collapse in a crash. It cracked under the weight of its own confidence. Number 9 is Miami, Florida, where the illusion was brighter and the fall more revealing. Miami's boom was powered by sunshine, status, and a flood of pandemic-era wealth. Luxury towers sold a lifestyle as much as a home. Rent climbed at historic speed, pushing locals aside while investors piled in. From Brickell to Miami Beach, glass towers sparkled with promise. But by the time construction caught up, the renter pool had thinned. Tourism softened. Remote workers rethought costs. Insurance premiums exploded. Special assessments piled up. Suddenly, owning property in paradise came with relentless monthly pressure. Vacancies crept upward, then accelerated. Incentives spread across buildings that once rejected applications without a glance. Airbnb owners retreated. Long-term rentals flooded the market. Miami still looks stunning from a distance, but behind the palm trees and skyline, the numbers no longer work the way they used to. The fantasy cracked, and the adjustment arrived quietly but firmly. Number 8 is Atlanta, Georgia, a city once praised as the balanced alternative to coastal chaos. Atlanta was supposed to be different, affordable, diverse, and grounded in real jobs. Developers believed that story completely. Tens of thousands of units came online in rapid succession, stretching from the urban core to the far suburbs. The assumption was simple: growth would absorb everything. Instead, renters hit a wall. Wages stalled, student loan payments returned, inflation tightened budgets. Demand didn't disappear, it downgraded. Roommates replaced solo renters. Moves were delayed. Vacancies spread. Buildings that once filled in days now compete aggressively for attention. Incentives stack higher each month, revealing the same truth seen elsewhere. Oversupply doesn't announce itself. It leaks into the market until leverage flips. Austin, Miami, and Atlanta share the same arc. Each was declared unstoppable. Each built aggressively into optimism. And each discovered that confidence fades faster than concrete sets. For renters, this is the moment of relief. For owners, it's a lesson in timing. What ties these boomtowns together is not failure, but miscalculation. Developers built for peak demand, not sustainable demand. Investors assumed yesterday's growth rate would last forever. Landlords priced units as if renters had infinite flexibility. None of those assumptions survive rising interest rates and tightening household budgets. When borrowing becomes expensive, leverage turns dangerous. Buildings that penciled out at full occupancy suddenly bleed cash at 80%. That pressure forces speed. Rent drops don't wait for consensus. They happen unit by unit, incentive by incentive, until the market resets itself. For renters watching this unfold, the emotional shift is just as important as the financial one. Negotiation is no longer taboo. Asking for concessions is normal again. Walking away has power. The silence in leasing offices tells a story no headline needs to confirm. Empty elevators, unused amenities, and quiet hallways all point to the same truth. Supply finally outran demand. And here's the deeper signal. These cities didn't lose relevance, they lost balance. When growth is driven by speculation instead of lived reality, it reverses violently. The lesson isn't to avoid popular cities, it's to recognize when momentum has already peaked. If you can see that early, you stop reacting and start choosing. That awareness is the real advantage emerging from the shift, and it's only becoming more valuable as the list continues. Those paying attention now will remember this period as the moment leverage quietly, decisively, and permanently change hands across multiple major rental markets. Number 7 is Las Vegas, Nevada, a city that has always lived on spectacle and confidence. For years, the Strip glowed brighter, cranes filled the skyline, and investors believed demand would never slow. Short-term rentals multiplied. Luxury apartment complexes rose across Henderson and Summerlin, each priced for tourists, convention crowds, and endless migration from California. But when travel softened and discretionary spending tightened, the math broke fast. Airbnbs that once booked every weekend flooded the long-term market almost overnight. Vacancy signs appeared where wait lists used to exist. Landlords who once dictated terms now undercut each other, stacking free months, reduced deposits, and flexible leases just to stop the bleeding. Las Vegas still looks alive at night, but behind the neon, units are sitting empty and carrying costs are piling up. The glamour didn't disappear. The leverage did. Number 6 is Phoenix, Arizona, where optimism hardened into oversupply. Phoenix was built on the idea that growth itself was permanent. Developers poured concrete at historic speed, convinced population inflows would absorb anything they delivered. Entire neighborhoods materialized in a blur, marketed to renters stretching their budgets in exchange for space and sunshine. Then affordability hit its limit. Wages stalled, interest rates stayed high, and migration slowed. Suddenly, tens of thousands of new units were competing for a renter pool that had stopped expanding. Investors who bought at peak prices realized too late that full occupancy was no longer guaranteed. Insurance, maintenance, and financing costs kept rising even as rents fell. Buildings that once felt brand new now feel heavy, like unfinished promises. For renters, the shift is unmistakable. Choice returned, negotiation returned. Silence in leasing offices became common. Phoenix didn't cool gradually. It tipped, and once it tipped, everything moved at once. Number 5 is Dallas, Texas, a city long described as untouchable. Dallas sold stability better than almost anywhere else. Corporate relocations, job growth, and suburban expansion created an aura of inevitability. Developers believed that scale alone would protect them, so they built and built and built again. Luxury towers filled uptown. Mid-rise complexes spread through Plano, Frisco, and beyond. But demand didn't rise at the same pace. Inflation ate into paychecks, renters downsized. Roommates became normal again, and suddenly vacancy rates climbed in buildings that had never experienced them before. Landlords who once dismissed negotiation now lead with concessions, free parking, utility credits, reduced base rents quietly advertised behind the scenes. Dallas didn't lose its economy, it lost balance, and imbalance is what forces competition. What connects Las Vegas, Phoenix, and Dallas is not geography or culture, it's timing. Each city built aggressively for a version of demand that no longer exists. Each assumed renters would keep stretching indefinitely, and each discovered the same uncomfortable truth. When supply overwhelms reality, leverage flips without warning. Landlords stop competing with renters and start competing with each other. That shift happens fast because carrying empty units is expensive. Mortgages don't pause, taxes don't pause, maintenance doesn't pause. The pressure forces decisions, and decisions accelerate change. There's a quiet emotional reversal happening inside these markets. Renters who once felt disposable are now the scarce resource. Walking away has power again. Asking for better terms is no longer awkward, it's expected. Meanwhile, investors who relied on perpetual appreciation are confronting something unfamiliar. Limits. The numbers no longer justify the confidence. Oversupply turns optimism into urgency, and urgency turns into panic. This is the stage where the pattern becomes impossible to ignore. Short-term rentals collapse into long-term listings. New developments open half full. Incentives stack higher every month. None of this requires a crash headline. It's visible in listings and concessions, in how quickly landlords respond to silence. The leverage shift is not theoretical anymore. It's measurable, lived, and accelerating. Subscribe and hit the bell because this phase doesn't stabilize quietly. The cities ahead show what happens when oversupply meets deeper structural pressure, and compared to what's coming next, these markets are only the beginning. Number 4 is Boise, Idaho, a city that became a symbol of escape during the pandemic and is now confronting the cost of believing that escape would last forever. Boise was never built for luxury scale. Its economy has always been rooted in modest wages, local services, healthcare, and education. But when remote workers arrived with coastal salaries, developers recalibrated overnight. High-end apartments rose fast, priced for incomes that didn't belong to the region. For a brief moment, it worked. Then remote work began to fade, tech hiring slowed, and migration cooled. Suddenly, the renters these buildings were designed for stopped showing up. Vacancy rates climbed quietly at first, then visibly. Units that once leased in days now sit for months. Concessions stack. Rents slide. Investors who bought assuming endless demand are discovering how unforgiving leverage can be when occupancy breaks. Meanwhile, the local workforce never returned at those price points. Teachers, nurses, service workers were priced out long ago. Boise didn't lose appeal, it lost alignment. And when alignment disappears, confidence follows. What's changed most isn't just the numbers, it's behavior. Landlords who once dismissed negotiation now initiate it. Renters hesitate, compare, wait. Delay becomes a strategy. People who felt this market was stretched years ago now feel validated. Boise's slowdown isn't dramatic, but it's decisive. Growth based on borrowed demand has a shelf life, and here, that shelf life expired. Number 3 is Seattle, Washington, where the break is louder and harder to ignore. Seattle built its rental market around the assumption that tech would expand forever. High-income workers, dense office culture, and constant hiring made luxury towers feel safe. But layoffs changed the equation. Remote work changed it further. Entire floors emptied. Not just apartments, but offices too. The renter base that justified premium pricing shrank faster than buildings could adapt. Rents have slipped, vacancies have risen, and projects once celebrated now feel stranded. Incentives that would have been unthinkable a few years ago are now routine. Cash credits, free months, flexible terms. Investors who paid peak prices are underwater, squeezed by financing costs that don't care about sentiment. And unlike past downturns, the confidence isn't bouncing back quickly. People are leaving, not in panic, but in patterns. Smaller cities, lower costs, different priorities. Seattle's shift is psychological as much as financial. Renters no longer feel rushed. Landlords no longer feel untouchable. The negotiation table flipped. Delay has power. Silence has power. That change spreads faster than any statistic. You can feel it in listings that linger, in projects paused midstream, in the absence of urgency that once defined the city. Boise and Seattle share the same lesson at different scales. Luxury cannot outrun local reality forever. When demand was imported, it left as easily as it arrived. If you sensed this coming, that wasn't pessimism. It was pattern recognition. Subscribe and hit the bell because the top 2 cities show what happens when this reset reaches full force. This moment matters because housing shifts don't reverse quietly. Once renters realize waiting works, behavior changes permanently. Once investors accept limits, capital retreats. Markets reset not through crashes, but through hesitation. If you're watching this unfold with clarity instead of panic, that's the advantage. Awareness always arrives before leverage fully transfers from owners to tenants across these cities. Number 2 is San Francisco, California, the city that once set the ceiling for rent in America and is now discovering that ceilings can collapse from above. For years, San Francisco was treated as immune. Innovation, prestige, venture capital, and scarcity were supposed to guarantee endless demand. But demand didn't disappear overnight. It dissolved quietly. Remote work didn't reverse. It hardened into permanence. Offices emptied, then neighborhoods followed. Towers that once symbolized ambition now advertise concessions unthinkable just a few years ago. Vacancy rates climbed to record levels, and rents slid far faster than anyone publicly expected. What broke San Francisco wasn't just economics, it was perception, safety concerns, quality of life debates, and the daily absence of activity changed how people felt about staying. Investors noticed before headlines did. Capital exited. Owners who bought at peak pricing now face loans that no longer match reality. Discounts stack, listings linger, and confidence evaporates. Prestige didn't protect rent when people stopped believing proximity mattered. Then there's number one, New York City, the final myth to fall. For generations, New York was the exception. Recessions came and went, but demand always returned. Owning or renting here was treated as inevitable, almost sacred. But 2026 looks different. Remote work severed the daily gravity that pulled millions inward. International buyers slowed. Finance and media cut jobs. Suddenly, the renter pool thinned in places no one expected. Manhattan rents retreated. Parts of Brooklyn and Queens followed. Incentives returned like ghosts from another era. Free months, flexible terms, quiet negotiations behind listings that once sparked bidding wars. The shift isn't explosive, it's unsettling. Buildings still stand tall, lights still glow, but urgency is gone. Investors who relied on constant appreciation now whisper about refinancing stress and foreclosure risk. Even luxury corridors feel negotiable. What's happening in New York isn't failure, it's reset. A city built on intensity is relearning balance. Younger professionals are choosing space over status, waiting over rushing. New York didn't lose relevance, it lost monopoly. And when monopoly breaks, prices adjust to reality, not reputation. San Francisco and New York reveal the same truth from opposite coasts. Prestige does not create demand. People do. When work detaches from place, when perception shifts, when capital senses friction, even the strongest markets bend. If this surprises you, it shouldn't anymore. You're seeing the system clearly now. Subscribe and hit the bell, because this shift isn't ending here. It's redefining how American cities compete, correct and reset in real time. What you've seen across these 10 cities isn't chaos, and it isn't coincidence. It's a repeating pattern that shows up every time rent breaks. First comes new supply that assumes yesterday's demand will last forever. Buildings rise, units stack up, and optimism fills spreadsheets. Then population growth slows, quietly at first. Fewer newcomers arrive. Fewer paychecks chase the same doors, and the math starts to wobble. Next comes the affordability wall. Local wages stop keeping up with rent, not emotionally, but mechanically. Tenants stretch, then stall. They take roommates, move back home, or simply wait. That pause is deadly for landlords. Vacancies appear, incentives follow, and suddenly leverage flips. This is why rent collapses don't look like home crashes. They move faster because leases reset in real time. Watch industry dependence closely. Cities tied to one dominant engine, tech, tourism, finance, are the first to feel pain when that engine coughs. Layoffs ripple straight into vacancies. Confidence drains. Investors notice before residents do. When investor ownership is high, panic spreads faster. Those owners don't negotiate emotionally. They react to spreadsheets, debt, and interest rates. Short-term rentals add fuel to the fire. When tourism softens or regulations tighten, thousands of furnished units flood the long-term market at once. That surge doesn't just add supply, it resets expectations. Renters realize they can wait. Landlords realize they can't. This checklist isn't about fear, it's about clarity. You can apply it anywhere. Ask how fast supply is growing versus population. Compare local wages to asking rent. Identify which industry pays the bills. Look at how much housing is owned by investors instead of residents. Count how many Airbnbs exist nearby. When enough boxes light up, rent pressure isn't coming. It's already here. The biggest shift isn't financial, it's psychological. Renters are no longer rushing. Landlords are no longer certain. Once that mindset changes, prices follow. If you want to stay ahead of where this breaks next, subscribe and hit the bell. Drop the city you're watching in the comments. The next investigation is already forming, and this cycle is far from finished. History shows this pattern repeating, But each cycle creates opportunity for those paying attention. The loudest voices arrive late. The quiet observers move early. You're not predicting disaster, you're reading signals. And in housing, signals always whisper first, long before headlines start shouting. That's how leverage quietly changes hands before most notice.